I want you to picture a machine, a really, really big machine.
Okay.
It spans the entire globe, from the dusty, scorching plains of West Texas all the way to the choppy, dangerous waters of the Black Sea.
It sounds like the opening to a spy thriller.
It kind of is,
Okay.
and we will get to that. But first, let's talk about the engine running this machine. Imagine it's operating in a world where its fuel price oil has dropped 15%.
Ouch.
And on top of that, the revenue this machine generated, it actually missed what the smart guys on Wall Street predicted. They were expecting $48 billion, but it only spit out roughly $45.8 billion.
Right, so in the corporate world, that usually triggers all the fire alarms. Panic, belt tightening, grim faces in the boardroom.
Exactly. You'd expect them to be scrambling. But that is not what happened with Chevron on January 30th, 2026. Instead, despite the revenue miss, despite the cheaper oil, they broke records.
That is a bit counterintuitive.
That's why we're here. Welcome to the Deep Dive. We are tearing into Chevron's Q4 2025 earnings report. We've combed through the call transcript with CEO Mike Wirth and CFO Eimear Bonner, and we're going to figure out how this energy giant is just defying financial gravity.
It's a fascinating case study.
Our mission today is pretty specific. I want to know how a company navigates what sounds like absolute geopolitical chaos. I mean, we're talking power outages in Kazakhstan,
Drone strikes.
near pipelines, and massive political shifts in Venezuela, and still manages to hand over a record amount of cash to its shareholders. How did that map even work?
Well, if you look at their slide deck, the big bold text says resilience through execution, which, I'll be honest, that usually makes my eyes glaze over.
Pure corporate speak.
It is, but when you actually peel back the layers of 2025, it's the perfect description. They integrated a massive acquisition with Hess, they hit production milestones that frankly seemed impossible a few years ago, and they cut costs like crazy.
Okay, let's pause there. Resilience through execution is great for a motivational poster, but I want to follow the money.
Yeah.
You said revenue missed, so they sold less stuff or sold it for less money. But the bottom line, they beat expectations.
Oh, handily. Adjusted earnings came in at $3 billion.
$3 billion.
Yeah, that's $1.52 per share. The consensus, what the experts thought would happen, was only $1.44.
So they squeezed more profit out of less revenue.
Precisely. And this is where it gets really interesting for anyone who owns the stock. Usually when times are uncertain or oil prices dip, companies hoard cash, they build a war chest.
Right.
Chevron did the opposite. They basically backed up an armored truck and just dumped cash on their shareholders' lawns.
Wait, hold on. $27 billion returned to shareholders in 1 year.
$27.1 billion to be exact.
Is that safe? I mean, are they cannibalizing the company to keep the stock price up? If revenue's down, how do they justify giving away that much cash?
That is the $27 billion question. It's a mix of dividends, about $12.8 billion in share repurchases. They even raised the dividend by 4%.
Wow.
And the reason they aren't cannibalizing the company comes down to a concept called high grading.
High grading. Okay, break that down for me.
Think of it like a garage sale, but for oil fields. Over the last few years, Chevron has been ruthlessly selling off its low-margin assets.
Expensive ones.
The expensive ones to run, the ones that don't produce much. They kept the high-margin assets where they can pump oil cheaply and efficiently. So even though oil prices are down, their cost to produce that oil is so low that the profit margin is still really fat.
So they aren't just focused on volume. They don't care about having the most barrels. They want the best barrels.
Volume is vanity, profit is sanity, as the saying goes. They are obsessed with profitable barrels. Plus, they're cutting costs everywhere else. They have this structural cost reduction program, saved $1.5 billion in 2025 alone.
And they're aiming for more.
Yeah, another $3 to $4 billion by the end of 2026.
Okay, help me visualize structural cost reduction. Is this just firing a bunch of people? Or is it something else?
It's more about efficiency. So imagine a household. You could save money by, starving yourself. That's not sustainable.
Right.
Or you could save money by installing solar panels, insulating your windows, using coupons. You're still living well, maybe even eating steak dinners, but your operating costs are plummeting. Chevron's doing the second one.
They're lowering the grocery bill while cooking fancier dinners.
That's a great way to put it.
Well, speaking of those dinners, let's talk about where the food is coming from. Because a huge chunk of this seems to be coming from the Permian Basin and this new Hess integration.
The production powerhouses.
Exactly. I feel like we talk about the Permian every time we look at energy, but they hit a specific number this quarter that really made me do a double take.
1 million barrels of oil equivalent per day.
That's absurd. That's more than some entire countries produce.
It is, and it just validates what they call their factory model. They're not wildcatting, sticking a drill in the ground and hoping for the best.
Right.
They've turned drilling into an assembly line. It's predictable, repeatable, and scalable.
And then there's Hess. They bought the company. Now it's fully integrated. Was it worth all the headache?
The data says yes. I mean, they hit their synergy targets, the cost savings, way faster than expected. But the real jewel in the crown there is Guyana.
That's the offshore play that Hess brought to the table.
Exactly. The Yellowtail development just achieved first oil. Another project, Hammerhead, just got the green light. That alone added 261,000 barrels per day to their portfolio. It's massive high-quality growth.
Okay, so they have the volume. But I found something in the transcript that sounded, frankly, like magic, or maybe chemistry class. They're using chemical cocktails to get more oil out.
Ah, the surfactants.
Yeah. Explain this to me like I'm 5.
Yeah.
Because it sounds like they're just dumping soap down a hole.
That's actually not a bad analogy at all. Think about a greasy frying pan. If you just spray water on it, the grease stays stuck to the metal. But if you add dish soap with surfactant, it breaks the surface tension. The grease just slips right off the pan.
So they're doing that to rocks deep underground.
Exactly. Oil gets trapped in these tiny little pores of the shale rock. It clings to the stone. By injecting these chemical surfactants, they make the oil slippery. It just releases from the rock and flows up the well.
And does it actually work? Or is it still just experimental?
Oh, it works. They are seeing a 20% improvement in recovery on new wells.
20%?
In the first 10 months, yeah.
Just by changing the fluid chemistry.
Roughly 20%. And just think about the economics of that. You've already paid millions to drill the hole. You've paid for the crew. Now, for the relatively low cost of some chemicals, you get 20% more product.
It's essentially free revenue.
Pretty much.
That explains the efficiency part of the theme.
Mm-hmm.
But they mentioned AI, too. Is that just buzzword bingo, or are they actually using it for something?
For once, it's not just buzzwords. They're using it in their supply chain negotiations.
How so? Like a chatbot haggling for steel pipes?
Sort of. The AI analyzes global pricing trends for materials, sand, steel, all of it, and it tells Chevron exactly what they should be paying. It gives them leverage.
So they use chemistry to boost the top line and AI to protect the bottom line.
You got it.
Okay, so the U.S. operations are a well-oiled machine, pun intended.
Mm-hmm.
But Chevron's a global company, and the rest of the world isn't quite as stable as West Texas. I want to shift gears to Kazakhstan. Because reading the transcript, things got a little scary over there.
Yeah, Kazakhstan is the other side of the coin. It's a massive asset for them. Tengiz-Chevroil, or TCO, one of the world's deepest, most complex superfields. They just finished a huge expansion there. But you're right, there was an operational disruption.
They called it recycle mode, which sounds like my laptop when it freezes. What does that actually mean for an oil refinery?
It means they weren't exporting anything. A temporary power distribution failure forced a safety shutdown. So recycle mode basically means the plant is just circulating fluid internally to keep the system safe, but nothing is leaving the facility.
And the CEO, Mike Wirth, he seems pretty eager to clarify what caused this.
He was very explicit. He wanted everyone to know this was a mechanical issue. A breaker tripped, it was not sabotage, and it was not a cyber attack.
Which is a crucial distinction, given the neighborhood they're in.
Absolutely.
But while the plant failure was mechanical, the pipeline situation, that was straight-up geopolitical warfare.
You're talking about the CPC pipeline. This is the massive steel artery that carries all that Kazakh oil to the Black Sea to be shipped out.
And it got hit.
The terminal did. In December 2025, a submarine drone struck one of the 3 mooring berths in the Black Sea.
A submarine drone? That's terrifying if you're trying to run a logistics business. You can't exactly put up a fence against that.
It just highlights the fragility of the whole global energy supply. This was due to military activity in the region, and Chevron was down to just 1 operational berth for a while.
Like trying to empty a swimming pool through a drinking straw.
Pretty much. They're back to 2 berths now, but it's a stark reminder. You can have the best tech in Texas, but in the Black Sea, you are at the mercy of submarine drones.
Well, speaking of conflict and complicated politics, let's go across the ocean to Venezuela. This part of the transcript really surprised me. I thought most Western companies had packed up and left Venezuela years ago.
Right, because of sanctions and instability.
But Chevron is. They're growing there.
Not only growing, but doubling down. Chevron's been in Venezuela for 100 years. They play the very long game. Since 2022, they've increased production by over 200,000 barrels per day.
But how? I mean, how do you operate in a country with that level of economic chaos and not lose your shirt?
They use a self-funding model. This is really critical to understand. Chevron isn't wiring fresh cash from California to Caracas. They aren't risking new capital.
So how are they paying for anything?
The operation runs on the cash it generates inside Venezuela. They pump the oil, sell it, and use that money to pay taxes, royalties, and this is key pay down the debts that Venezuela owes to Chevron.
And whatever's left over.
It gets reinvested into fixing pumps and pipelines. It's a completely closed loop.
That's clever. It de-risks the whole investment. But here's the part I had to read twice. They are shipping that Venezuelan crude back to the United States, to their own refineries.
Yep. Pascagoula, Mississippi, and El Segundo, California.
But why? We just talked about the Permian producing 1 million barrels a day. We're swimming in oil in the U.S. Why drag it all the way from Venezuela?
Because not all oil is created equal. The Permian produces what's called light sweet crude. It's thin, almost like gasoline, but those big refineries on the Gulf Coast were built 30, 40 years ago.
Okay.
They were designed to chew through heavy, sour crude, the thick sludge-like stuff.
So we have the wrong kind of oil for our own factories.
In a way, yeah. For years, these refineries has been running inefficiently or buying heavy oil from the Middle East. Venezuelan oil is the perfect chemical match for them. It's not about politics. It's about pure chemistry. Chevron is reconnecting a supply chain that just makes their refineries run better.
And the CEO thinks there's more room to grow.
He mentioned potential for another 50% growth in the next 18 to 24 months, but, and this is a big but, he put a huge asterisk on that.
Let me guess. It depends on the politicians.
Entirely. On U.S. government authorizations and local laws, Venezuela just passed a new hydrocarbon law, and I guarantee you Chevron's lawyers are reading every single word of the fine print on that right now.
It's a delicate dance. But it seems like Chevron is willing to dance with anyone right now if the resources are there. They're making moves in the Mediterranean.
Natural gas. Big time. They're expanding in Israel, the Leviathan and Tamar fields, and in Cyprus. They see gas as the future for that entire region. The goal is to double their earnings from there by 2030.
And they're picking up new acreage in Africa and South America, Egypt, Namibia, Nigeria, Brazil. It feels aggressive.
They increased their exploration acreage by 50% compared to 2023. So yeah, they are planting seeds for the next decade. But the thing that really caught my ear, and maybe you caught this too, was the comment about the Middle East.
About Libya.
Libya and Iraq. They signed an MOU, a Memorandum of Understanding with Libya.
And just to be clear for everyone, an MOU isn't a binding contract, right? It's not a marriage license.
No. It's more like agreeing to go on a second date. But it signals intent. Chevron is looking at Libya again. And Mike Wirth said something very specific about why these countries are suddenly calling.
He mentioned the Trump visit.
He did. He noted a notable uptick in inbound inquiries from countries wanting American investment, specifically following a visit by President Trump to the region.
So, regardless of where anyone stands politically, the CEO is reporting that the diplomatic landscape is changing their business opportunities.
Exactly. He's seeing a reopening. They are staying, but listen to why. Wirth argues they actually have an advantage because the market is becoming so isolated.
How is that an advantage?
Because everyone else is leaving. Supply is dropping. When supply drops, prices go up. So Chevron can make good margins there simply because they're the last one standing.
That is grimly pragmatic.
It is. But think about the irony here. You have Venezuela, a socialist state with a history of seizing assets, trying to become more attractive to U.S. investment, and then you have California enacting policies that make it less attractive.
It's a total inversion. The capital is finding less friction in Caracas than it is in California.
That's the paradox. And Chevron is navigating both. They are literally shipping Venezuelan oil to California refineries, connecting a country desperate for cash with a state desperate for energy, despite the political friction in both places.
So let's wrap this up. We started by asking how this massive machine operates in such a chaotic world. What's the final verdict?
The verdict is that Chevron has become a master of adaptation. They are bigger, stronger, more resilient, to quote the CEO. But that's interesting. They use cutting-edge tech surfactants and AI to squeeze efficiency out of safe places like Texas.
Right.
Then they use diplomacy and patience to recover value from risky places like Venezuela. And they use extreme financial discipline to keep paying shareholders, even when the market turns against them.
So they're balancing mechanical failures in Kazakhstan and drone strikes in the Black Sea with record payouts. It's impressive.
It is. The revenue miss was just a function of oil prices. That's just gravity. The earnings beat, that was management skill. That was the machine working perfectly.
Well, as we close out, I want to leave you with one final thought.
Right.
We usually think of the U.S. as the stable center of the energy world, right? And places like Libya or Venezuela as the chaotic outliers. But listening to this call, you really start to wonder if the poles are shifting.
That's the provocative question, isn't it? We are entering an era where formerly closed-off nations are actively courting U.S. investment to save their economies. At the same time, parts of the U.S. are becoming these incredibly difficult regulatory environments.
So what happens if that trend continues?
Well, if capital flows out of American states and into places like Libya or Venezuela because the business climate is actually better there, what does that role reversal mean for the future of American energy security?
It's definitely something to chew on next time you're at the pump. That's it for this deep dive into Chevron's world. Thanks for listening, and we'll catch you on the next one.